Good morning, ladies and gentlemen, and welcome to this panel discussion addressing recent regulatory, compliance and tax developments. My name is Claudia Franks, and on behalf of SRP, I want to thank you all for joining us today. I will now pass you over to our panel, but before I do, please note that this session has been pre-recorded and thus the speakers can't address any live questions. I will now hand you over to our experts.
Thank you very much, Claudia. My name is Anna Pinedo. I'm a partner in the New York office of Mayor Brown, and Mayor Brown is very pleased to be a sponsor for this year's SRP Structured Products Conference. As Claudia mentioned, this panel focuses on regulatory compliance and tax developments affecting the structured products and derivatives market in the United States. And to cover these timely topics, we have a panel. And I'm going to ask each of our panelists to introduce themselves and tell you a little bit about their areas of focus. So I'm going to ask to start with Brad Busher, please.
Hi there. Good morning. My name is Brad Busher. I'm the Chief Administrative Officer and General Counsel of Insperix, LLC. We recently concluded a merger with a California-based company and changed our name from InCapital to Insperix, and we are one of the largest distributors of retail debt products, including market-linked securities. Thanks, Anna.
And now my colleagues, first, Brad Berman.
Thank you, Anna. I'm of counsel in the capital markets group in Mayor Brown, and I've been working in the structured products area with Anna and others here for really since 2008, pretty broad practice. So thank you.
Remold.
Yeah, this is Remold Ragersman. I'm a tax partner with Mayor Brown on the West Coast, specialize in capital markets transactions and financial products. And we'll talk a little bit later today about what's happening in Washington in this area.
Great. So with that, I'm going to ask Brad Berman to begin our session with a discussion of the transition away from IBOR-based products and how that's affecting our structured products and market-linked issuers, and of course, the underwriters and distributors of market-linked products. So Brad, maybe you can tell us a little bit about the state of affairs now and what issuers should be thinking about.
Okay, thanks, Anna. Let's talk about the current state of LIBOR. As almost everybody's heard, December 31st of this year, they're going to stop publishing 1 week and 2 month US dollar LIBOR and also all non-US dollar LIBOR tenors. So that's the end of this year. Not a big effect in structured notes because really the main one it's ever used is 3 month US dollar LIBOR. Now, 3 month and other US dollar LIBORs are going to cease after June 30, 2023. So what have the banking regulators been saying about this? The key statement by the banking regulators was the interagency statement on LIBOR transition. That was November 30, 2020. There was a statement by the Board of Governors, the Federal Reserve System, the FDIC, and the OCC, and they jointly said that banks shouldn't enter into any new US dollar LIBOR contracts after December 31st of this year. Now, that's despite the fact that most of the useful US dollar LIBOR tenors are going on through June 30, 2023. And what they defined new contracts were new US dollar LIBOR lending, debt, preferred equities, or securitizations, and new US dollar LIBOR derivatives transactions. This was reiterated by the Federal Reserve on March 9th of this year, and also the CFTC came out on July 14th and made a statement to market participants to take steps to stop issuance of new derivatives linked to LIBOR and to transition away from LIBOR and legacy contracts no later than December 31st of this year. So one question that's come up a couple of times is, in response to this, is What about indices that have a LIBOR component? We see that a lot. We see volatility control indices that bounce into what they call the cash element. Many times is 3-month US dollar LIBOR. So, these types of proprietary indices, there's an issue here. So what are index providers doing about this? Well, we've seen some statements. S&P Dow Jones Indices put out an FAQ on the LIBOR transition and did a consultation, which was published July 28th of this year. MSCI did a consultation on potential replacement rates for LIBOR and Ionia and their indices. That was in December 2020. And IHS Markit put out a findings and requests for feedback in July 2020. And these were all very similar, and they all analyzed the LIBOR issue and consulted with the market on whether they using the new risk-free replacement rates for the various IBORs. All three of the providers mentioned the desirability of having a forward-looking term rate, which would be a great replacement for LIBOR, because of course LIBOR is forward-looking, depending on the tenor, because some of the indices use an overnight. We're using an overnight LIBOR, which would be for SOFR would be a perfect replacement. In the July 2021 S&P consultation, they said US dollar LIBOR is going to be replaced with SOFR, both overnight and term. Again, it would depend on the tenor. So I think that what's going to happen is going to depend on the methodologies of these indices. Some methodologies have, foresaw this because they were newer and built in a replacement mechanism for LIBOR. Other ones, it looked like from the consultations, they actually are amending their methodologies, which that's why they're coming out with consultation and a lot of advance notice. I think the next issue is, what about outstanding legacy LIBOR floating rate notes? Of course, we're aware that without any action, many of these notes, because they're fallback provisions, and not just notes, but loans, mortgages, securitizations, they would become fixed rate notes on July 1st, 2023. So how to resolve it? Just focusing floating rate notes. New York, what they called the legislative solution, April 7th of this year, Article 18C of the New York General Obligations Law was signed into law. And this is primarily aimed at US dollar LIBOR contracts, again, not just floating rate notes, but mortgages, securitizations, et cetera, that have the 2006 ISDA definition fallbacks, or they don't have any fallbacks at all, and are governed by New York law. So it resolves that. What it does is essentially it will flip them over into basically the ARC's fallback rates into SOFR. It has no effect on outstanding US dollar LIBOR notes that already have the ARC fallbacks to SOFR in there. It has no effect on non-US dollar LIBOR floating rate notes, even if they're governed by New York law. Now, there was a time when we realized LIBOR was going away, but before spring of 2019, when the ARC came out with the SOFR fallbacks, a lot of notes went out with what they called a discretionary replacement option, where the calculation agent in consultation with the issuer could pick kind of a market standard rate. The statute doesn't disturb those either, it kind of confirms that choice. And it also has a safe harbor against lawsuits for people who are like calculation agents, issuers who are implementing what they call the benchmark conforming changes. These are kind of small changes, but necessary ones when you're going from LIBOR to SOFR, timing, business day definitions, spread adjustments, et cetera, that have to be made so they can't be sued. But there is a shortcoming to the New York one. First of all, it only applies to New York law governed contracts. That's not going to help for most mortgages. They're going to be the law of the property, where the property is located. The bigger question is a conflict with the Trust Indenture Act of 1939. And the example is, if you had this perfect sort of storm where if the last US dollar LIBOR setting on a note was higher than replacement SOFR in the spread adjustment, a plaintiff could claim that that Section 316B of the Trust Indenture Act was violated, and that her right to interest was impaired or affected without her consent. And of course, state law can't preempt federal law. So what's the next step in this? Well, there is federal LIBOR legislation. And there's what they call the Adjustable Interest Rate LIBOR Act of 2021, That was reported out of the committee to the full House of Representatives on July 29th of this year. That was done by a voice vote. I'm told that's a good sign. This is not limited to any state law. It will specifically amend Section 316B of the Trust and Venture Act to resolve that problem. The structure is very similar to the New York legislation, Article 18C, and it also contains a safe harbor against lawsuit, just like the New York one. And this will, once passed, it will preempt Article 18C of the New York General Obligations Law. Now, another.
Sorry, Brad, we don't know what the timing is for the passage of the federal legislation, do we?
No, I mean, people keep saying this fall, but fall was last week and hasn't passed yet. So, okay. The other rate that some people have asked about is, what about CMS? We know CMS has a floating rate leg that references 3-month US dollar LIBOR. So that's a potential problem. What's going to happen to the CMS rate after June 30, 2023? Well, there's a couple possibilities. In March of this year, the ARC published a white paper discussing a suggested fallback formula for the US dollar CMS rate. And essentially, they came up with a formula you could build into your CMS rate notes, such as floating rate notes, even though the white paper was focused on derivatives. And that essentially, upon the cessation of the US dollar, of the floating rate leg, it would continue to function properly, but it would be calculated based on an expected SOFR CMS rate that would be published. So you could craft your CMS rate notes with this in mind. The only problem is the SOFR CMS rate doesn't exist. So that was one option. Not a good solution. Okay, the second option is you go to the CMS, the administrator's website, Intercontinental Exchange, and you'll see a consultation there on the potential cessation of the pound sterling LIBOR CMS rate. And that rate too is the same issue as a floating rate leg based on pound sterling LIBOR. And they are going to cease publication of pound sterling CMS at December 31st of this year. There is no discussion of replacing pound sterling LIBOR with SONIA. So, and what they note on the website is they said they're going to consult on the potential cessation of the US dollar LIBOR CMS rate in due course. So I think as a warning to all of us, if you're doing CMS rate notes, definitely have a robust fallback provision in there, because the future is pretty cloudy for CMS rate. In SOFR for floating rate notes, last year, the ARC came out with 4 variations on compounding daily SOFR. And essentially, this is all dealing with the big problem with doing SOFR for floating rate notes is, as you remember, LIBOR was a forward-looking term rate at the beginning of a 3-month interest period. You knew what the rate was, you knew what the payment would be 3 months hence, no problem. SOFR is a daily backward-looking rate. You have to kind of cobble it together to come up with really a backward-looking term rate. And one of the issues is you don't know the last part rate entry to figure out your calculation until the date of the interest payment. And now you've got to calculate your rate and pay people the same day, which doesn't really work. So they came out with, there's 4 different ways to do SOFR, compounded SOFR over a period of time. And one of them is called look back. And that one essentially is for each day in your interest period, you're looking back. You're not really taking the reading that day, you're taking it a number of days prior, a number of US government securities days prior to that date. So for example, if your interest payment date's a Friday, you've actually figured out your last payment the Friday before. So by the Friday of the interest payment date, you've had 5 days to figure it out and get people paid. So that's one way. The other one is called observation period shift. And this seems to be a popular one we see a lot. And essentially, you've got your typical interest period from and including an interest payment date to, but excluding the next one. Let's say the interest payment date's a Friday. Well, within that is a period of time called the observation period that is shifted back, let's say 2 US government securities business days. So they're measuring the interest from the Wednesday prior to the previous interest payment date to the Wednesday prior to this interest payment date. So that way you build in that example, 2 US government securities business days, a little bit of time to figure things out, get people paid. The last one they call payment delay. That simply delays payment for 2 business days after the interest payment date, except at maturity or redemption. So if the interest payment date's Friday, you're going to get paid on Tuesday. What they do for maturity or early redemption is they introduce what they call rate cutoff date or lockout period. So if Friday was the maturity date, they might lock in the interest rate for the last 3 or 4 US government business securities days on Tuesdays, so you get paid on the maturity or redemption date. There's also the SOFR index. The SOFR index is very convenient. When the first 3 I went to, if you go to the ARC's website and you look at these floating rate notes, this is very complex formula for figuring out the interest that I think probably scares away retail investors. So the SOFR index is a lot easier. The compounding's built into the index. It's measured since April 2, 2018 when SOFR started. No need to run any fancy formulas. You just pick a start date and an end date in the index. The difference is going to be the rate floored at 0. The sample one uses observation period shift. It's also published, the index is published on its value date. And then lastly, term SOFR, which is something we've all been waiting for, and it is here. The CME group has started publishing it. It's a forward-looking term rate, and it has a number of places to kind of go in the world of replacing LIBOR. For example, the ARC supports it. By the way, the ARC has made a number of statements about term SOFR. And it's important to remember the ARC doesn't make rules, it's just recommendations. Okay, so they support the use of term SOFR for the business loan market, multi-lender facilities, and middle market loans. They don't support it for using term SOFR for most derivative transactions. They're saying it should only be used for end use or facing derivatives intended to hedge cash products that reference term SOFR. So what about floating rate notes? Doesn't it sound like a great idea, a forward-looking term SOFR rate, like plug and play for LIBOR, which is a forward-looking rate? Well, what the ARC supports is using term SOFR in the fallback waterfall, which is when they came out. If you were going out with a US dollar LIBOR note now, you should be using the ARC's fallbacks to SOFR, and the first fallback was term SOFR. So they support the use there. And they support the use as the first rate that would be the ARC recommended rate, where the New York statute or the federal statute are stepping in and flipping LIBOR over to SOFR. They would recommend its use there. But for new floating rate notes, the ARC recommends keep using overnight SOFR or the SOFR averages we discussed. So that's a little bit problematic. I think they're concerned about the depth of the underlying transactions for term SOFR. But I think one thing is, the ARC is mainly, it has a lot of market participants, but some of the key players are banking regulators. It's possible we might see corporate issuers coming out with term SOFR floating rate notes, despite the ARC's statements on this. So
Brad, just in closing, before we change topics, do you continue as issuers of structured notes update their programs, since we're getting to year end and a lot of issuers do annual program updates? Is the advice to issuers just to take LIBOR out completely?
I think at this point, yeah. There's no point, especially if you were an issuer with any connection to the financial industry. There's no use irritating the regulators. And of course, if you were a corporate, you could always add it back in the top level document. But I think at this point, it's probably a good idea to remove it.
Okay. I think the other thing to mention is Brad talked about all of the note options. So SOFR, of course, and all the various options, and CMS and all the various options. Brad, is it worth mentioning just the ISDA changes to the interest rate conventions?
Yes, October 4th, the new 2021 ISDA rate definitions are going to affect. The old 2006 descriptions are going to be completely gone because mainly one of the reasons is they depended on polling for fallbacks, which is completely out of style. So the new ones have a floating rate matrix. It's going to look very different. All of the programs that, for example, your Fed funds rate, CMT rate, something like that, those descriptions will need to be replaced. So it's important to remember if you're updating your program starting October 4th, you're going to need to do a new kind of description.
Okay. And then finally, for our audience, most everyone probably in our audience is aware and has adhered to the ISDA IBOR protocol. But for all derivatives, ISDA came out with its IBOR protocol, which has been very popular and has gotten enormous take-up by market participants. And the IBOR protocol establishes really a fix for the definitions in master agreements to address the change for LIBOR. So with that, we're going to move to a problem that is now really besetting the fixed income market, including the market for market link products. And I'm going to ask Brad Busher to explain a rule that not many of us in the fixed income market had really ever spent too much time thinking about, 15C211. So Brad?
Yeah, thanks, Anna. So this is a rule, as Anna indicated, that has been on the books since 1971. And in April of this year, the Commission provided some guidance that the rule really focuses on fixed income securities. And I'll talk about that in a little bit more. But what is Rule 15C2-11? The rule governs the requirements that broker-dealers must satisfy before they publish or submit quotations in a quotation medium in the over-the-counter market. How do they define the over-the-counter market? It's quotes published away from a national securities exchange. As indicated, this rule applies to all securities. The rule specifically exempts municipal securities, and the Commission reiterated an initial exemption that exempts securities such as government securities, including treasuries, are also exempt under the rule. So the question is, what is the purpose of this rule? The purpose of the rule is to focus on investor protection by mandating that investors have access to current and publicly available information of issuers, and that brokers are able to confirm that certain information about the issuer is current and is publicly available before they quote that security. I think it's helpful to go back and look briefly at the background. So as indicated, the rule was adopted in 1971. The reason it was adopted was to try and stem fraud and deception in the microcap equity space, namely penny stocks, pump and dump schemes. And while the rule did not distinguish amongst various securities, the Commission, when it adopted the rule, clearly noted that there is not a prevalence of fraud in the fixed income markets. So fast forward from 1971 to 1998, the SEC proposed various amendments to the rule, but again reiterated the fact that the fixed income markets do not experience the type of fraudulent conduct that they have seen in the equity markets, and particularly the small cap equity markets. In 1999, the commission re-proposed certain amendments to the rule, again observing the lack of manipulation in the fraud markets. And interestingly, they proposed that they would consider exempting 3 types of debt securities, namely non-convertible debt securities, non-participating preferred stock, and asset-based securities that contained an investment grade rating. No action was taken on those proposals. So again, fast forwarding, now we're at 2020. The SEC revises the rule and makes some of the disclosure requirements a little more stringent and places some additional burdens on broker dealers and certain others, which we'll talk about in a second. In the adopting release, there were only 3 very minor references to fixed income securities. So out of an 84-page release, there's no discussion regarding the application of this rule to the fixed income markets. As mentioned, in April of this year, the SEC has now taken the position that the rule applies to debt securities that trade over the counter. Chairman Gensler of the commission has indicated that he's very focused on transparency in the fixed income markets. So likely this is part of his focus. So how do you, I guess the next question is how do you comply with the rule? So the rule essentially says that it is unlawful for a broker or dealer to publish or submit for publication a quote in a quotation medium unless the broker dealer complies with one of 2 different alternatives. Under the first alternative, the broker dealer must obtain issuer information. The broker dealer must determine that the information is current and publicly available and must review the information for material accuracy and reliability. Pursuant to the second alternative, a broker or dealer could rely on a publicly available determination made by a quotation medium that is a qualified interdealer quotation system. What is a qualified interdealer quotation system? Essentially, it's an ATS or an alternative trading system. So if you look at a couple of the definitions, you can see the broad scope of this rule. So if we look at the definition of a quotation medium means any interdealer quotation system or any publication or electronic communication network or other electronic device that is used by brokers or dealers to make known to others their interest in transactions in any security, including offers to buy or sell at a stated price or otherwise, or invitations of offers to buy or sell. Again, very broad definition. Likewise, the definition of a quotation is also extremely broad. That means any bid or offer at a specified price with respect to a security or any indication of interest by a broker-dealer in receiving bids or offers from others for a security or any indication by a broker-dealer that wishes to advertise its general interest in buying or selling a particular security. So what is the nature of issuer information that needs to be reviewed? With respect to public reporting companies, it's relatively straightforward. And it's primarily information that can be found on EDGAR. It could be a registration statement. It can be an offering circular under Reg A, annual report, or other periodic reports. The information, the rule also highlighted information disclosed by foreign private issuers. Namely a foreign private issuer that is exempt from registration under Section 12G of the Exchange Act that publishes information on the company's website or through another electronic delivery system that is made available to the public in its primary trading market, and that complies with the informational requirements under Rule 12G32B3. So if an issuer is not subject to those disclosure requirements, the rule contains a catch-all provision. And this is where, the ATS community and broker-dealers now need to determine how to ensure that information is publicly available, or alternatively, provide it themselves if they capture it from a particular issuer. The catch-all provision includes several categories of information, namely the issuer's name, address, state of incorporation, information concerning the security, the par amount of the security, the outstanding securities, identification of the transfer agent, a description of the business, a description of products or services, a description of the issuer's facilities, the name and title of corporate insiders, and the most recent balance sheet, profit and loss statement, and statement of retained earnings for the last 2 years. There are also categories of information that address certain potential conflicts of interest. That information does not need to be disclosed publicly at this point. There are certain exemptions under the rule. There's an exchange quotation exemption. Unsolicited customer indication is exempt. There's a piggyback exemption if you're piggybacking off an existing quote on an ATS, which is not an unsolicited customer indication. As mentioned, municipal securities and exempt government securities. There is a average daily trading volume exemption or exception as well. So if there's average daily trading volume in excess of $100,000 per day for the past 60 days, coupled with an asset test, including $50 million in assets and $10 million of shareholders' equity, that security is exempt. There's an underwriting exemption with respect to quotes by the named underwriter within 90 days of a registration statement or within 40 days from an offering circular. Another challenge for broker dealers and ATSs are record retention requirements. You need to retain records for a period of 3 years, the first 2 in a readily accessible location. So what is the current status of this rule? So on Friday afternoon, the commission issued a no action letter indicating that while the rule is going into effect tomorrow, at least the new application of the rule as it applies to debt securities that trade over the counter, the SEC will not bring enforcement action for a period of 3 months. Interestingly, Commissioner Pierce issued a letter on Friday afternoon where she indicated that there are potential serious consequences based on this rule applying to the debt markets. And she has indicated that from her perspective, the commission should consider reopening the rulemaking process, taking additional comments, and then taking a very thoughtful approach to seeing what debt securities might apply. I am hopeful that perhaps the commission may go back and look at the 3 categories of securities they were considering exempting back in 1999, and perhaps that's a path forward for the commission. I think with respect to market link products that you're quoting in the secondary market in the States, obviously look at the nature of the issuer. If it's a foreign private issuer, you may be able to look at information that they have posted on their website, as I indicated. If not, you're going to have to take a look at the catch-all provision and make sure that that issuer has published information on its website that complies with each of those categories. So that's, in a nutshell, that's where things stand with respect to Rule 15C 2-11.
Thanks, Brad. I think that it's unlikely that there'll be further relief. I think the 3-month relief is probably the best that the industry's going to get. I don't know if you agree with that.
Yeah, I do. It seems like a number of the commissioners, specifically Chairman Gensler, are very focused on ensuring that there is additional transparency in the fixed income market. So I would agree with that perspective.
Yep. So I would say to all the structured products folks out there, although there's not a very liquid secondary market, there is a secondary market that most issuers, affiliated broker-dealers maintain. In order to maintain the secondary market, you're going to have to comply with this rule by January. So important to get familiar with it very quickly. With that, I'd like to turn to Remel to give us a briefing on what we might expect in the coming days in terms of changes to tax legislation.
Sure, thanks, Anna. So on the federal tax side, the House Ways and Means Committee has released a portion of the what's called the Build Back Better Act. So this is the reconciliation bill that is being worked on in Congress, for which no Republican support would be needed, and which would not be subject to the filibuster rules. I will just highlight a few of the items that are in that bill that are relevant kind of for, structured products and financial products. The first one is capital gains rates are proposed to go from the current 20% to 25%. One little wrinkle is that would be effective for sales that occur after September 13, 2021. So you're going to get into this situation where, you're going to have to figure out for transactions during the tax year, during your year 2021, which transactions happened, before or on September 13, and which ones happened after, because it would be a different rate depending on when the transaction took place. The second provision I wanted to point out on sections, so this is Internal Revenue Code, Section 871M. As you probably know, 871M deals with dividend equivalents. Has been a pretty complicated provision for the last few years that the market grapples with. And the Build Back Better Act proposes to expand the provisions of 871M to also apply to derivative transactions on MLPs, Master Limited Partnerships, which typically don't throw off dividends or very little dividends because they are partnerships and flow-throughs. But so 871M would be expanded to MLPs. The third relevant provision is the expansion of the wash sale rules. At the moment, under current law, wash sale rules apply to stock or securities. And the proposal is to expand that to cover more assets, including foreign currencies, commodities, and cryptocurrencies. In addition, the wash sale rules would be expanded to situations where a related party purchases substantially identical assets. So if you have husband selling one asset and wife buying something similar, or child buying something similar, that could invoke the wash sale rules if the new rules get adopted into law. The last one I wanted to mention are the constructive sale rules. Those rules are proposed to be also expanded to include digital assets such as cryptocurrencies. There are many additional changes in the bill on the tax front. I'm just highlighting these that I just mentioned, but it's a pretty expansive bill with lots of tax changes. And then I will also note that just to remind you from the earlier comment at the beginning of this session that this is pre-recorded. It is Monday morning today, and things are going to happen pretty fast during this week. In Washington is the expectation, so it could be that things change for the next few days by the time you listen to this presentation. But at least this is the state of play on Monday morning. So with that, Anna, back to you.
All right. So just thank you very much, Remel. A few thoughts to wrap up our session today. Brad Busher alluded in his presentation to the fact that we have a new administration in the U.S. I think it's something that we can't overstate enough. There definitely is a new tone in Washington at the Securities and Exchange Commission with SEC Chair Gensler. And we are seeing that, and that is certainly something that we all in the market linked and structured products and derivatives industry should be very much attuned to. There are a number of things that are very much on the horizon that we should stay focused on this fall. Coming up in just a couple of days' time, on October 6th so just days away is the effective date for the security-based swap dealer framework. So for many of our issuers and their affiliated broker dealers, this is highly relevant. Most of the derivatives or most of the instruments that we use to hedge the exposures that are created as a result of issuing structured notes are security-based swaps. And so very important to be mindful of the fact that the framework finally comes into effect in October. And so that's very relevant. The other fact of life is that Chair Gensler has a very enforcement-focused mentality. We are seeing more and more enforcement actions and more focus on investor protection, more of a retail oriented focus from the commission. And we're seeing this both in terms of his attention to retail focused product, his attention to anything in the crypto field. We're seeing this as well with his statements and attention regarding products, indices, funds, anything that purports to market itself as ESG related. For the past 2-3 years, it has become very popular for the structured products and market link community to try to devise indices that have an ESG focus. We should all, again, remain attentive to the fact that there will be regulation in the not too distant future relating to funds that use ESG or purport to have an ESG focus. And this will have ripple effects for ESG indices or other products that purport to be ESG related. Finally, after a period, after a drought in terms of enforcement actions in the structured products area, we've seen a couple of enforcement actions, again, more related to sales practices related to ETNs in the structured products area. So it bears mentioning that sales practices should remain top of mind, in particularly in an administration that has as its focus the retail investor and investor protection. So with that, we thank you very much for your time. And I want to thank our panelists, Brad Busher, Brad Berman, and Remel Riegersman for joining me today. And we look forward to answering your questions, which you submit through the online portal. We also encourage you to click through and to read some of the supplemental materials that Mayor Brown and that Brad Bushred and SPAREX has provided. Thanks so much.
Fantastic. Thank you so much, Anna, Brad, Bradley and Remold, for all your insights shared with our audience today. For our delegates, we hope that you enjoyed this session and the discussion. We're looking forward to seeing you at 12:40 during the next session, which is a fireside chat, where we'll be discussing the future of the Canadian SRP market. Thank you very much.